Okay, good morning everybody. Benjamin here, your banking analyst. So today's presentation webinar will be me taking a take on OCBC, and followed by Nicholas, who will be covering the O&M sector. So first up, an update on OCBC. Last Tuesday, OCBC announced its offer for Wing Hang Bank at last. Okay, so just to run you through the terms of the offer, OCBC announced the offer to acquire Wing Hang Bank at 125 Hong Kong dollars per WHB share. So this acquisition will be in cash, and this amounts to be about 38 B Hong Kong dollars and converted at $6.16 per Hong Kong dollar. For one Sing dollar is about 6.23 B Sing dollars. Right, so first of all, you'll be funded initially by the internal resources of OCBC, and after that post-acquisition, they'll be funded by a mix of debt and equity. Right, so OCBC's rationale for this acquisition is to expand its Greater China footprint, to tap into the offshore RMB market, and then provides its portfolio with a more balanced geographical mix, and also enhancing its broader funding base, which means it's easier for them to raise Hong Kong dollars as well as RMB funding. Alright, and also to expand this franchise value and its product capabilities. So management expects the acquisition to be EPS and ROE accretive by 2017. Okay, but we need to highlight that they mentioned that it's going to be accretive by 2017, even though Wing Hang Bank currently is already profitable if we consolidate the bottom line to OCBC. Okay, so the market's reaction has been a bit of a relief, because the offer is said to be at 1.77 times of Wing Hang Bank's net book value. So it's a bit lower than the previously hyped up speculation of 1.9 times of price to book throughout the last couple of months. Right, so on our side, we feel that the offer value is actually at about 2.02 times, because we like to be a bit more conservative. And so initially the 1.77 times has not taken into account the final dividend for Wing Hang Bank, which is about $1.62 Hong Kong dollars per share. Right, so if you adjust for this final dividend payout, right, which will be sometime in May, as well as the property valuation reserve, right, because the property valuation is not something that will be realized unless they sell off the assets. Right, so if you adjust for these two, the actual offer value, right, is about 2.02 times, right, not 1.77 times. Okay, so the key takeaway that we want to highlight is that with this acquisition, even if we take into account at 1.77 times of price to book, equity will need to be issued later on, probably 1 to 2 years down the road, right? Because with this acquisition, there's an increase of the risk-weighted assets, right, which needs to be used to calculate their Basel III ratios, which is we look at the Common Equity Tier 1 ratio, right? So currently, the transitional basis is down about 300 basis points, right, with this acquisition, and then if we factor in the fully loaded by 2018 CET1 ratio, which needs to be at least 9%. Right, so during the briefing, the management did not disclose their estimates of their fully loaded figure. Based on our estimation, it has been shaved off by about 290 basis points to about, previously FY13 year end was about 10.9%. So based on our estimation, with this acquisition, it should be down to about 8%. Right, so at minimum, it needs to be raised on 9%. Right, so with that, OCBC might possibly need to issue at least 2 B Sing dollars worth of equity. So this means that for shareholders, we face some form of minor dilution. Right, so back to the our opinion, right, on this acquisition, we don't put it in a much favorable light, right, because they are basically paying for a mid-sized bank, right, for their strategic expansion, right, but for a mid-sized bank with an inferior ROE profile to OCBC itself, we don't feel that this acquisition is really justified for the premium they are paying. Hence, we have for this portion, it should be the rating should be at whole, right? So we still maintain our whole rating, where the target price has been cut to $9.58. Right. So that's all for OCBC.
Morning, ladies and gentlemen. Welcome to our weekly market commentary. Hi, today we actually issued a sector report on our offshore marine sector. Here's our key main takeaways on the sector report. Basically, we feel that due to current market conditions, stock prices have not taken into consideration the increase in the supply of jackup rigs, and hence this will actually affect the rig builders and oil services companies' return going into 2014. For the second point is that the E&P spending growth in 2014 is showing a slowdown with a growth rate of 4% year-on-year in 2014 as compared to 6% in 2013. And with an increase in new build fleet over the next few years, we believe that the market will not be able to absorb the increase in supply going forward. And last point is the replacement cycle, which will kick in, which is highly anticipated by the market analysts. But we feel that at this current point in time, this will probably not kick in due to the high utilization rate. If you look at the diagram on top, we actually incorporated the new market condition and make adjustments on models, and we actually lower our rating for Keppel Corp and SembCorp Marine to a neutral and a reduced rating respectively, and we also updated our target price for that. We are keeping our rating for Ezion and Ezra due to their niche market exposure. Give me a second. Hi, there's some technical problem over our side, but we will try to fix it ASAP. Just give us a second. Good. Thanks. Right, so we move on to the further discussion on the offshore market outlook. On the demand side of the equation, we see that there's a lower growth rate in 2014 as oil companies focus on cutting costs and maximizing shareholder returns. Spending plans and budget announcements made so far point to a 4% growth year-on-year, and there could be some downside to this figure if Brent oil prices remain flattish or slightly lower than $107 per barrel. And according to forecasts from DMP markets, if you look at the diagram here, you can see that the offshore E&P spending is forecasted to grow by only 1% in 2014 as compared to the growth CAGR of 18% from 2010 to 2013. And if you look at the diagram here, the figures that we consolidated from all the major oil companies, NOCs, as well as smaller oil companies, this reflects capex spending growth of only 4% this year, as compared to 12 to 9% previously last year. So this actually indicates a slowdown in E&P spending, and this will be a concern to oil services companies as well as rig builders within Singapore's offshore marine space. On the supply side of the equation, we are also now in the midst of a delivery boom for both jackups and floaters. Floaters being semi-submersibles as well as drill ships. The jackup fleet will be growing at over 20% when we factor into all the new builds which are coming into service in 2014 and later, while the floater fleet is expected to grow even more by 30% over the current new build cycle. Attractive yard prices through 2014 2011 to 2012 had driven new build orders. And if you look at the diagram on the left, we expect to see the total rig deliveries to reach a peak in 2014 and 15 for the first time ever since the early 1980s. Over at the deep water market segment, it has also become obvious that the deep water rig market is oversupplied for 2014 and 15. Of the if you look at the diagrams below, we can see that the even though utilization rate has been hovering above 95% over the past few months, day rates have started to come down, and we are seeing this as an early warning sign that the deep water market has already reached the peak. If you look at the diagram on top, you can see that of the 56 floaters scheduled for delivery by 2015, 31 are still uncontracted. This is another warning sign that the deep water market will be flooded with new capacity going forward. On the shallow water market, day rates, however, remains high as well. This is also true for the utilization rate, indicating that there's still steady demand for the jackup rigs. However, we are concerned with an oversupply issue as well as new rigs continue to be delivered over the next 2 years. If you look at the diagram on top, you can see that there are at least 80 jackup rigs to be delivered by 2015, but 70 still remain currently uncontracted. And with regards to aging rig fleet, it has been widely perceived by market analysts that the aging rigs face higher risk of displacement as customers favor newer rigs, just like people favors newer cars, and this by right should drive the higher utilization of newer rigs going forward, and hence the displacements of older rigs. In fact, currently there are 46% of global jackup rigs, as well as 29% of global floaters that are above 30 years old. This could drive replacement demand going forward, thus countering the effect of supply growth, according to market analysts. However, we beg to differ. Based on our analysis on rig replacement rates, it actually shows that the older rigs are likely to be removed from an active fleet in a substantial way only in a downbeat market. Okay, by downbeat market, we actually mean that a market with a utilization rate of below 80%. If you take a look at the chart below, you can see that there will only be substantial replacement of the entire fleet when the utilization rate is below 80%, below the 80% mark. After which you will see substantial rig replacement of more than 2%. Hence, based on the current market condition with a utilization rate of more than 90%, replacement cycle is highly unlikely to kick in anytime soon, unless we see a sharp drop in utilization. Over in the subsea market, while the long-term fundamentals for subsea market remains robust, with significant capital investment in offshore infrastructure worth more than $150 billion expected from 2014 to 2018, the outlook remains muted in the near term. In fact, in a recent market commentary by Subsea 7, one of the top 3 subsea players in the market, it expects a delay in project awards to remain a feature of subsea industry, driven by clients' capex constraints. Hence, based on the underlying market fundamentals, we actually made adjustment to our forecast on the on our offshore marine coverage. We see limited positive catalysts within the offshore space currently at this point of time. Hence, we actually advise our clients to remain selective, and we actually prefer counters which still provide good value with good visible earnings growth. At this level, we are still accumulate on Ezion, and we reiterate our neutral rating for Ezra. We downgraded Keppel and SembCorp Marine to neutral and reduced respectively, and we continue to see the most downside potential in SembCorp Marine itself. Right, for Keppel, despite the downgrade, we continue to like Keppel for its resilient offshore marine O&M operating margin over the next 2 years, and we still believe that the company is well positioned to benefit from any increase in E&P spending from NOCs, given its near market, near customer strategy. However, lower growth in global E&P spending as well as increased competition from the Chinese yards are likely to result in lower order wins going forward and compressed margins. Hence, we actually cut our FY14 order forecast from $7 billion to $5.5 billion in view of the less positive sector outlook. We lower our EPS forecast by for FY15 by 3% to factor in the new orders estimate. We trimmed our target price from $12.34 to $11.35. And hence, based on valuation, we downgraded Keppel from accumulate to neutral. As for SembCorp Marine, same, because of their exposure to the building of drilling rigs. We acknowledge that the strong reputation of its proprietary Pacific class jackup rigs, and we continue to like the diversification of its product mix into drill ship as well as semi-submersible accommodation, semi-submersible, and other new products, and higher ship repair contributions from its new Singapore yard. However, we actually downgraded SembCorp Marine to reduce, as we expect operating margins to remain under pressure within the near to medium term due to the higher execution risk when it starts to execute its first drill ship order at the new Brazilian yard in the second half of this year. We also lower our FY14 orders target from $4.7 billion to $3.7 billion as the sector outlook turns less positive this year. Our target price is cut to $370, and we actually downgraded the SembCorp Marine from neutral to reduce. For Ezra, we remain neutral. For Ezra, we see that the management is still actively looking to unlock values for its subsea business, the EMAS AMC, with a potential listing in the US and Europe as one of the options. If this were to materialize, we believe that it will maximize the firm's competitive position, improve its international profile, and access to capital, and ultimately unlocks value for shareholders itself. But given the near-term headwinds for the subsea market, as we mentioned earlier, we believe that the company will still there will still be execution risk for the company itself, as the company continues to build up its operation in the subsea business. We continue to like Ezion for its niche market positioning. We believe that due to the lack of competition within the SEU markets, Ezion will continue to do well, despite the less positive O&M outlook in general. So today we'll share more about share with you guys more about the investment merits for Ezion Holdings. Here's a snapshot for Ezion Holdings. Its last trading price last Friday is at 214. Our target price for Ezion is 257. Well, Ezion basically has two main business segments. It is a vessel operator and a vessel owner. Its main bulk of its revenue actually comes from lift boats and service rig business, or in short we call it SEU. Currently it has 31 SEU vessels, including those under construction. Its offshore logistics support division constitutes 27% of operating income as of last year. Basically, its exposure mainly comes from the Australian LNG projects, with more than 40 vessels contributing to this particular segment. So why invest in Ezion Holdings? There are three main investment merits for Ezion Holdings. One is the high earnings growth for the next 2 years with a 40% CAGR. This is mainly driven by the fast-growing SEU fleet. Second is that Ezion is well positioned for the robust lift boat demand outside Gulf of Mexico, as Asian and Middle East oil companies get more and more familiarized and understand about the value proposition of the lift boats. We believe Ezion will benefit from the increase in lift boat demand going forward. Third is Ezion's high ROE business model with secured contracts of more than $2.5 billion. This provides earnings visibility going forward. Let's go in depth into each investment merits. One is the high earnings growth profile at a 40% CAGR over the next 2 years. Basically, earnings has been growing exponentially from $8 million in 2008 to more than $250 million by FY15 expected. This is mainly driven by its gradual move from SEUs rather than the offshore logistic business. They actually started building the exposure within the SEU division over the past few years, and this has started to see results since 2013, and we actually continue. We'll still be able to see earnings growth over the next 2 years with EPS growth of 71 and 15% in FY14 and 15. Currently, all of the vessels that are other vessel contracts that are actually secured, only 17 of them are contributing at the moment as of end of FY13. 13 units are yet to be contributing, and this should drive earnings growth going forward. Second is Ezion's robust. Second is the robust lift boat demand within the Asia Pacific region as well as the Middle East. Ezion is more commonly used in Gulf of Mexico. As you can see on the chart on top, 250 SEUs in North America is used to support 3,000 plus of offshore platforms. However, there are only 62 SEUs in this part of the world, which includes Southeast Asia, Middle East, and West Africa combined, supporting similar number of platforms. Hence, we believe that as oil companies started to get familiarized and understand the value proposition of lift boats and service rigs, more demand will come in, and this will give more opportunity to Ezion itself. And one thing to take note is that the lift boats that are currently used in the Gulf of Mexico are specifically designed for that geographic location, meaning to say that it is generally not being able to be used in other markets like Asia, Middle East, as well as North Sea, due to the three main reasons. One is the deeper waters. Second, harsher weathers, and third, the requirement for classification society approvals. This is especially important after the Gulf of Mexico incident. Hence, going forward, we believe that with more litho demands coming up from the Asian market as well as the Middle East, Ezion will be well positioned for this increase in litho demands. Third is the high oil business. Ezion currently has secured SEU contracts of which worth more than $2.5 billion. This provides earnings visibilities. Basically, Ezion is somewhat similar to a rig operator, like Transocean and Seadrill. However, unlike Transocean and Seadrill, where they are actually leasing out jackup rigs and semi-submersible, Ezion actually leases SEU units. They are basically taking contracts from oil companies and outsourcing the building of SEUs to yachts, arranging financing, and once the completion of the SEUs, they actually leases it out to oil companies on a day rate basis. Ezion actually works on at least 30% ROE business model due to the lack of competition and strong demand. As you can see on the diagram on top, this actually is actually a simple illustration on how each SEU contracts actually benefit Ezion's P&L. Ezion is able to take on about 70% debt for each construction of the SEU units. And besides having exposure in the Southeast Asia and Central American market, Ezion has also secured SEU contracts in other parts of the world, including North Sea, Africa, Middle East, as well as Alaska. So what are the key risks for Ezion itself? One is any delays in the delivery of SEU units will actually impact Ezion's earnings. This is fair, but we believe that Ezion will be able to manage the construction of its SEU units well. However, bearing the fact that if let's say there is any delay, definitely will impact the earnings. Second is Ezion's high capex model. Given the fact that Ezion actually takes up to 70% of debt for every construction of the SEU units, this will definitely increase Ezion's gearing. However, we believe that as more SEU units starts to contribute, this will actually benefit its cash flow, improve its free cash flow, and we expect gearings to fall as more SE units kicks in, starts to contribute by FY14. In fact, we are seeing that the gearing has actually peaked in end of FY13. We should be seeing improvement in the gearing going forward. Third is the competition, which could drive down our ROEs going forward. Yes, it is true that with such high ROE business model, competition will come in. However, based on our market analysis, we are only seeing the closest competitors which we see out in the market is Gulf Marine Services, which actually focuses on the Middle East market. The rest of the competitors are actually focusing on the Gulf of Mexico market, which is pretty far away from the exposure that Ezion has, which is the Asia Pacific market. Hence, currently, competition is still not a major concern for Ezion at this point of time. Hence, all in all, we continue to like Ezion based on 4 investment merits. One is Ezion's high earnings growth at 40% 2-year EPS. This is mainly driven by its SEU fleet expansion. Currently, out of the 31 vessels that are actually contracted, 13 of them are still yet to contribute, and this should drive earnings growth going forward. Second is Ezion's exposure in the robust SU market in the Southeast Asia and Middle East market. This should benefit Ezion going forward. Third is Ezion's high-earning business model, which with supported by SU contracts worth more than $2.5 billion. This should provide earnings visibility going forward. And last but not least, this is very important because for every investor's valuation is very the price that you go in really makes a difference. And based on our analysis, we are seeing that the Ezion is still relatively cheap in terms of P multiple as compared to other offshore marine companies within the Singapore space. Ezion is currently trading at 6.6 times FY15 PE, while its peers are all trading above this PE range, being asset owners like Ezra, Swiber, and Mermaid Maritime, or yachts like ASL, NLC, as well as FUD. In terms of PB valuation, we acknowledge the fact that Ezion has a higher PB of 1.9 times, but we believe that it is justifiable because Ezion has higher ROE as compared to the rest of the counters as well, with ROE of more than 25%. Hence, we continue to like Ezion. Our target price for Ezion is 257. Our rating still remains the same at accumulate. That's all we have today. We welcome any questions you might have.
Hi, we have a question here on China. Basically, what is the likelihood of a Lehman Brothers moment happening in China in the next 1 to 2 years caused by collapse of the shadow banking or property bubble? Yeah, we've highlighted this as a key risk, key macro risk going forward. And to be quite honest, we don't have a lot of visibility on this, how it will, on the likelihood of it happening. Except to say that I think the Chinese government's balance sheet is very strong, and this is a possibility that we're looking out for, but it's really hard to say how likely it will happen. But I mean, we only take comfort with the fact that if it does happen, right, the money is there to stopgap the system.
There's a question on Wilmar, whether or not Wilmar will be the next commodity play. Currently, at this point of time, our sector rating for commodity is still neutral. Hence, we believe that the recent spike in share price in terms of for Olam and Nova is mainly driven by its M&A news. But having said that, we have a cumulative rating on Wilmar due to its exposure in the China itself. We believe that the China will continue to drive earnings, especially the recovery of its oilseed and grain segment. Wilmar is also actively building up its sugar division, and we are seeing growth within the company itself in terms of each and every individual division. Its Palm rig business is also robust, remains robust despite the increase in the Indonesia refining capacity increase due to the fact that Wilmar does more value-added pump products like biodiesel and oleochemical. This should continue to support Wilmar's earnings going forward.
Hi, Benjamin here. I have a short question on Wing Hang Bank OCBC. So, question is, will Wing Hang Bank still retain its name after OCBC takes over? So, when we went for the management briefing on the acquisition, right? Management has indicated that they will still retain Wing Hang Bank's brand name, but OCBC name will be incorporated. And after, if the offer goes through, which they expect to be in about August this year, right? After they acquire 100%, they will delist Wing Hang Bank from Hong Kong Stock Exchange, right? And again, they will still preserve Wing Hang Bank's name, but the OCBC name will be incorporated, just like what they did with the other banks like OCBC and SIP in Indonesia. Yep.
Alright, just as a follow-up, because the question is a likelihood of a Lehman Brothers moment happening in China, and I think Ben just now actually talked about what was happening on the China shadow banking side. On whether there's a property bubble in China, I think that right now, if you're looking at the country as a whole, the developers have started to shift their focus more on the underlying demand, as in the occupiers, those people who are buying it for the main reason of actually staying in it. These are the urbanization effect. In terms of property bubble, which is like more focused on the tier 1 markets like Chongqing, like Beijing, like Shanghai, you can see that the developers are already taking kind of a step back. They are kind of scaling back a little bit, and they are trying. I think that the growth in the prices there is more or less arrested for the super luxury apartments. So yeah, I don't really foresee that happening unless there's suddenly a euphoria whereby there's a lot of investment capital that's flowing right into the market for this tier 1 super luxury space. Right. Hi, we have a question on what's the next sector rotation play. We don't really do a lot of sector rotation in term for the Singapore market anyway here, but we have stock picks that we think will outperform the market, and our current top ones are Bousted, Pan United, First Resources, M1, Silver Lake, and these you can find in our you can look at the research reports in our Poems research page to find out why we believe these are so. Hi, there's a question, any research updates on OOE Limited? Currently right now there is actually not much, and we do not really have any update. Our target price to stand as per previous report, and we have an accumulate rating on it. Yeah, for the most part, the fundamentals of the company have not changed, and they're still, I think, currently having a huge pile of cash on hand, and they're really still looking through all the potential projects, investments, and it's kind of still open-ended for them. So yeah, our rating still stands. It is still poised for more growth, and we have an accumulate rating for the parent company of OOE Limited. Alright, there's also a question on Yoma. So what will be their outlook investing return on the Myanmar market right now? Firstly, I think that is kind of important to point out that Yoma's stock is currently very opportunistic. It's in like not much. There's only like a single, and most another two developments counter for this. So it's really we believe that the share price will be quite volatile if there's any further news and whatnot. So definitely not the top of our picks. Right. Outlook investing return in Myanmar market. Currently, right now, for the private equity deals and all the real estate deals that's going to Myanmar right now, if the deal is went in before the spike in land prices, they are looking at a very opportunistic 20 or 30% returns for a norm, and anything higher than that, even more so for a relatively undeveloped plot of land there and whatnot. So, yeah, definitely that would 20% will definitely be what you're looking at for individual project returns. Currently, right now, Yoma's land prices has really kind of shot up really high, so the return will be more 12 to 13%. It is really doesn't really make sense for it doesn't really make much commercial sense, from a risk return point of view. So yeah, hope that answers your questions, or at least give you a rough guidance as to what you're looking out for Yoma.
Hi, so I have a question that we highlighted UE about 3 months ago, and the price has gone up. Any more upside? Okay, so the for UE in short, right? I mean, we're just waiting for more clarity on WBL. So UE now owns about 67% of WBL, and I mean, it's still in the process of digesting this acquisition. It's also been looking for a buyer for the Rian's automotive portfolio. So once there's more clarity, if there's any signs of sale, for example, you break up the group and then you sell up and then pay down the debt, then I think we'll be able to comment more on the upside. But even for now, right, using our very conservative RNAV, back at the seminar, we estimated that we are looking about $2.90 RNAV, and today's share price is about $2.03, so it's trading at 0.7 times, which is still pretty attractive, given that we think this RNAV is very conservative. Thank you.
This is just a question on Sinheng, whether there's any update. For Sinheng, the last update there was basically in late February. They were awarded exclusive distribution of Acromet's self-erecting cranes. Now, besides this announcement, there isn't actually any update on Sinheng, so everything's per normal. For the impact of this distribution award for Acromet self-erecting cranes will actually take a couple of months to a year before you actually see significant revenue impact. So as I understand, in the next 2 or 3 months, they will be basically promoting these cranes, demonstrations, etc., etc. Yeah. Here's a question about Nasdaq. Nasdaq PE is more than 30. What is your view on this? Is the valuation at tipping point yet? Actually, the thing is, if you have seen my market presentation earlier this year, as well as recently, I think 2 weeks ago, I already had said there was a lot of weakness being inbuilt into the S&P, and I said that I expected a minor correction in early this year, which already happened, and another one later this year in May, but it could have been adjusted a bit earlier. I will say that it looks as though there is going to be at least a short-term cycle at this point in time, and we're getting closer to what I think is a high probability correction zone. So if you're investing in the US market, I'd definitely be cautious at this point in time. The short-term cycle may have already started, already started, which I already guided 2 weeks ago that it will start soon.
Right, for the OMM questions, let's go back to the front. There's someone who asked about the difference between Ezion and Automarine. Well, basically, Ezion and Automarine are within the offshore marine sector, but Ezion has a focus on leaf boats and service rig, while Automarine is a OSV builder as well as an operator. So they are operating in two different kinds of business segment. We don't have. We are currently not covering Automarine, hence we feel that it's not appropriate for us to comment a lot on Automarine itself. Sorry about that. There's also a question on the recent announcement by Ezion and the JK Tech Holdings. We feel that Ezion has always been on the lookout for opportunities to divest its marine-based business after the Ocean Sky announcement has been caught off. So we believe that this new announcement by Ezion recently should be one of the one of the ways for Ezion to actually divest its marine business to other companies. This is a good thing. We will keep you guys on updated with any announcement from the management side itself. There's also a question on is Swiber in the same league as Ezion or Ezra? Well, Swiber is pretty small in terms of market cap, but for Swiber, it has more exposure on the subsea market. Probably Ezra will be a more good comparable in terms of the comparison. But you have to bear in mind that because Swiber is a relatively smaller companies, they might not be able to take up larger subsea contracts, unlike Ezra. So in terms of Ezra, we still see, like what we mentioned earlier, we still see execution risks going forward as Ezra continues to build up its EMC business. We believe with more contracts being secured over the next few years, Ezra should be able to reach a sustainable, more comfortable operating margin going forward. Our rating for Ezra is still neutral at this point of time.
Hey guys, Kenneth here, the market analyst. This is just to address all the TA questions that are here. Okay, so let me just reiterate the cycle and what's going on in the US market. Okay, one, in late December, I guided in our webinars that I gave a whole host of reasons and guidance for this year, that there will be weakness in early the year and major weakness in the middle of the year. Okay, and then in that webinar, I mentioned that wait for the January barometer to come into effect first, which will probably increase the probability of greater weakness this year. So if you check the webinar on 11th February, that's when I updated, because January did in fact end downwards as we expected. Hence, I said that the probability now of a May to August weakness is extremely high, and I'll keep you posted. Now, if you just saw last week's webinar, if you look at the archive for last week's webinar, right, I actually gave more like basically 4 to 5 reasons why the market looks really weak and that a correction can start soon. Okay, so this is to address all these questions about market weakness. Okay, if you look at last week, price was consolidating, but there were many reasons, from momentum to breadth to a few other reasons, and I mentioned that it looks really bearish, and a downward break is much greater probability than upward break. Okay, so please look at the last week's webinar for those updates.
Hi, there's a question on the major shareholders for Ezion Holdings. Currently, the top 3 major shareholders for Ezion is first, Mr. Chu Tianming. He's the CEO of Ezion Holdings with a stake of 15.5%. Next is Franklin Resources with a 6.6% holdings, as well as FMR, which has 5% holdings. Right. There's a question on why Ezion's dividend payout is low. One of the main reasons why Ezion's dividend payout is low is because of the company's focus in building up its SEU fleet over the past few years. We believe, due to the fact that they want to expand their SEU fleet, they will not be diverting the cash over to dividend payout. With more investments in the organic growth, we believe this will in turn drive our earnings, which in turn will also benefit shareholders. There's also a question. This person is asking that with the recent cut in E&P costs from oil majors, this has actually impacted drillers like Transocean, Diamond, Offshore, Seadrill, and so how does this impact Ezion? Well, for Ezion, we believe that since Ezion is exposed to the leaf boats and service rig market, which has indeed fewer competitors, we believe that the less positive O&M outlook kind of like is actually kind of like shielded from Ezion itself due to its niche market exposure. Hence, we are still pretty positive on Ezion. Any major competitors for Ezion on the SGX? Well, the closest competitor for Ezion is actually GMS, Gulf Marine Services. However, it is not listed in SGX, and its primary market focus is actually in the Middle East. The rest of the competitors for the leaf boat market is actually within the US itself, particularly in the Gulf of Mexico. Companies like Hercules, etc. So currently, no, we don't see any real competitors for Ezion at the moment within the SGX. There's a question on our OS group. I'm sorry, we don't really have a coverage on our OS group, so we believe it's not fair for us to comment this company at the moment. I'm sorry about it.
Hi, question here on whether we see that because the US market is down and Kenneth has guided that it's probably going to be weak until maybe the second half of the year, whether what's the effect on the STI? The STI is actually holding up pretty well, whether there'll be decoupling. Historically, downward movements of U.S. indices have resulted in similarly downward movements for the STI. But we have the same thought of whether this time may be slightly different because we have changed a lot since the global financial crisis. The Singapore market is, in terms of where its earnings come from, is more diversified now. And we do note that the US has already had a huge run last year, whereas the STI has been flat to negative, right? And also the S&P 500 is at stretch valuations, whereas the STI is at low valuations of 12 to 13 times. So although we see that there will probably be some negative effect on the STI, we don't think it will be very large, right? It will be much more muted than whatever downside we're going to see in the US market. That's what we believe. Okay, if there are no further questions, we will end the webinar. Thank you for all your participation, and we look forward to having you all on board again next week. Thank you. Bye-bye.